He's been seen on CNBC, the Fox News Channel, and the Fox Business Channel. His articles can be found on MarketWatch, Seeking Alpha, TheStreet.com, and many other places. He's the author of the weekly Best Stocks Now newsletter and the inventor of the Best Stocks Now app. He's president of Gunderson Capital Management. Here is professional money manager Bill Gunderson.
And welcome to the Friday. It is October 1. It is the weekend edition of the Best Stocks Now show with professional money manager Bill Gunderson of Gunderson Capital Management, getting a little bit of lift out of the market here to end the week. It's mostly Merck, though. Big news on Merck. Merck is a component of the Dow. Merck has a pill for COVID, not a jab, a pill for COVID. And Dr. Scott Gottlieb was calling it a game changer. And there's also a small biotech involved there with this Merck news. So we're going to finish off probably with the Dow up, but the NASDAQ slipping and sliding all over the place, negative. And those tech stocks continue to come under some pressure. Now, I'm not seeing interest rates rising. In fact, interest rates are falling down to 1.49. So not interest rates that are hurting the NASDAQ. It must be supply chain, valuation jitters. Who knows? We'll get into more detail on that. September was not a good month for the market. It usually isn't. October is usually not a good month for the market, but having been a professional money manager for the last 21 years, I can just tell you that no 2 years are alike. It's pretty hard to set a rule like go away in May, get out in October, things like that, because every year is different. But we did have a pretty sloppy September. And I would blame mostly, you had the Evergrande China problem, you had the China crackdown on their companies, you had a little bit of rising interest rates, and you had inflation and supply chain issues. Anything else to worry about? Oh, there's always things to worry about. So welcome to the Best Stocks Now show with professional money manager Bill Gunderson of Gunderson Capital Management. I run a virtual office, a virtual financial planning, investment management office. I've ran it for the last, since 2006, I guess, is when I started Gunderson Capital. I personally am located in Charleston area of South Carolina. I was in San Diego for many years and decided to try something different, my wife and I. So far, we like the change. We like it out here in South Carolina. We're in fishing season right now. We're in the height of fishing season right now with giant redfish in the Charleston Harbor and up the rivers and big speckled trout and flounder and the likes. A lot of shrimp in the water right now. So hopefully, man, I've worked about 10 hours every day this week. Hopefully, maybe tomorrow after I send out the newsletter, get out and do a little bit of fishing. But I fish in the market every single day. You know, I admire these fishing guides. They know what's going on. They know where the bait is, what they're eating, what time of day, what tide to be fishing, what color lure to be fishing. Why? Because they're in the water every single day for the most part. They are dialed in. They're even dialed into the moon. One time we weren't catching any fish, and the guide said, "It's the moon." Okay, all right, well, you know. Anyways, I've been neck deep in the water every single day for the last 21 years. That's what I do for a living. It's one of my passions. Watching the markets, watching sectors of the market, watching asset classes, and watching individual stocks. I particularly like companies that have changed the world, the way we do business, changed technology, changed medical, changed the drug industry, changed the car industry, the computer industry, the telephone industry. I've seen a lot of technology revolutions during my life, and a lot of disruptive companies that have disrupted the old ways of doing things. And I'm constantly on the lookout for more disruptors. I spent some time early in my career as an analyst writing up research reports on individual companies. That was fun. I learned a lot about valuation doing that. You know, my real love when I first got in the business was more tilted towards momentum investing, CanSlim investing. Being from the West Coast, that's where the Investors Business Daily is headquartered, up in Los Angeles. I still use MarketSmith for my online charts, which is part of my daily process. Valuation, very important. Momentum, very important. Looking at stock charts, very important. I don't believe you can do it just on value. I don't believe you can use just momentum alone, and I don't believe you can use just charts alone. I think you have to blend them all to try to make those best decisions. Well, I came up with a ranking system about 10, 12 years ago. It was a giant spreadsheet. I'm a spreadsheet junkie. And eventually it made its way into a database. And eventually we created an interface for that database, and we called it beststocksnow.com. Oh, beststocksnowapp.com. Beststocksnowapp.com. And we have an Apple version, the Best Stocks Now app. We have a Android version, Best Stocks Now app, and the web version is called beststocksnowapp.com. You can try it out for free, but it's a ranking system. I currently have about 6,000 stocks, ETFs, mutual funds, inverse ETFs, open-ended funds, etc., closed-end funds in that database, and it's a ranking system from 1 to 6,000. It ranks the sectors for me. It ranks the asset classes for me. It's based on valuation and momentum and the charts and a little bit of safety factor involved there. It makes my life as a professional money manager a lot easier. In fact, it's an invaluable tool for me. I don't have to look at 6,000 different equities every single day. It narrows it down to the ones that have the nicest, best combination, blend of value, momentum, healthy stock chart, and also that safety factor. And these are usually companies that are leaders at what they do. The name of my show is Best Stocks Now. The name of my weekly newsletter is Best Stocks Now. The name of my portfolios, Best Stocks Now. I'm trying to fill those portfolios with the very best stocks that I can find in any given discipline, whether it's dividend-paying stocks, fast-growing ultra-growth stocks, large-cap growers, or even bonds. I run a bond fund, too, that is based on bonds that come from Best Stocks Now. What makes a Best Stock Now? Well, generally speaking, they dominate their industry. They're growing their earnings. That is very, very important for me. That's what gives you capital appreciation, that growth in earnings. Stocks follow earnings. So do indexes. That's why it's so important to watch the earnings of the indexes. Best stocks now for me are moving. Okay, they have some momentum. They have what's called alpha. They're generally outperforming the indexes and their sector and their peers because they have better products, better management, things like that, and a little bit of safety. I don't delve into the Bitcoin miners and the micro-cap biotech stocks and the meme stocks and things like this. I'm looking for quality. And at the end of the day, I run a large cap growth portfolio, a dividend and growth portfolio, a ultra growth portfolio, an emerging growth portfolio, and a bond portfolio. And I have a heck of a lot of fun managing those portfolios. And in fact, I show you what's in my hand in my newsletter every week. It goes out to my clients and my my live trading subscribers. That's who gets my newsletter every week. But I make an offer during my show on Friday, and I guess during the week. I offer 2 free weeks of my newsletter. You can go to my website at gundersoncapital.com, gundersoncapital.com, and sign up for 2 free weeks of the newsletter. You should get it sometime tomorrow. I'm going to really hurry as fast as I can. Maybe I can get out fishing by about noon tomorrow, get on the water, bring home some redfish for dinner. We'll see. But anyways, I will be working on that newsletter. It has the macro outlook. I do believe in market timing. It has the portfolios, what I currently own, what I've been selling, what I've been buying. Go to gundersoncapital.com. We'll be right back with what's going on in the market. We're in a correction right now. How much deeper can it go? This is Bill Gunderson. Back here to the second quarter of the Best Stocks Now show with professional money manager Bill Gunderson of Gunderson Capital Management. Well, if you've been waiting for that correction in the market, we have not had a 5% correction all year. Oh, no, we can't say that anymore. We are now down, the Dow is down now 5% from its all-time high that it set about 3 weeks ago, something like that, as we approached 36,000. Now we're back under 34,000. So we are now in the midst of a 5% plus correction, which those come along from time to time. But at the same time, we've also got to be on guard that it doesn't turn into something worse. And that brings up the subject of market timing, okay? It also brings up the subject of passive investing versus active investing. Well, during my 21 years as a professional money manager, I've witnessed 2 very sharp bear markets and many deep corrections in between those bear markets. Of course, back in the year 2000, we had the dot-com crash, the bubble in those dot-com stocks, and the NASDAQ ended up going down 79%. And I know a lot of retirees that, sat and watched it and did very little on the way down. They were told that things would come back, don't worry. Well, you know what? Pretty soon things were way down, and they didn't come back. There's very few stocks that survived those days, that dot-com crash. And when it was all said and done, the NASDAQ was down 79% from the high. Well, okay, the NASDAQ got up to 5,000 back then. It took about 12 years to get back to 5,000. Now it's been trading around 15,000 recently, and there's talk of another bubble in the market, which we'll talk about here in a bit. I also witnessed the financial crisis of 08, 09, when the S&P 500 went down 53%. Okay, so here we are in the midst. Let's put this in perspective. We're in the midst of a 5. The NASDAQ's now down about 7% from its high. And we start looking at this point in time for technical support levels, and there's some critical ones coming up here that I'll be watching very, very closely. All right, now that's the micro picture. Now let's go a step back a bit to the macro picture. Since 2009, when the Dow bottomed out around 6,600, the Dow has gone to 35,000 from 6,600. Okay, it was 5-bagger, a little bit more. And had you panicked and sold every time there was a 5% correction along the way, you would have missed out on some pretty big gains. And, you have to ask yourself, did you participate in this 12-year bull market, what drove this 12-year bull market, and when will it end? Well, let's start with what drove this 12-year bull market. In real estate, it's all about location, location, location. In the stock market, it's all about earnings, earnings, earnings. Bottom line, after-tax profits, otherwise known as earnings. We ended the third quarter of 2021 on Friday. In a couple of weeks, the companies, publicly traded companies, will start reporting their earnings, what they made, how much they sold during the third quarter 2021. Those sales and earnings will be compared with the same comparable quarter last year, the third quarter of 2020, which obviously was heavily influenced by COVID. This quarter, right now, we're looking for about 27% growth versus that quarter last year. Now, we could exceed that number, or we could miss and not make that number. This will be a very important earnings season that will begin in a couple of weeks, because if it's been earnings that have been driving the market higher, think about it. Back in 2009, the earnings of the S&P 500 were $53 per share. That's where they bottomed out. This year, we're looking to make $200 per share. That's a 4-bagger in earnings, and the market's been a 5-bagger. We've also seen some expansion in the multiple along the way because of the artificially low interest rates that the Fed has been maintaining through their massive balance sheet and their asset purchases, okay? So we have a high multiple on the market created by the Fed, which creates some vulnerability, obviously. If interest rates start to climb here, which they did this past week, which they did back in February and March, you're going to see the multiple on the market contract, and the market will contract along with it. But if the earnings come in very powerful once again this quarter, like they did last quarter, that could offset that shrinkage in the multiple. So we'll see. I write about this in my newsletter every single week. In fact, if you don't look at any other part of the newsletter, go immediately to the macro outlook of the newsletter. I'm a guy who's been right about the market for the last 12 years, okay? And I am a market timer. At some point in time, when I start to see the earnings erode, especially future earnings expectations, that probably will spell the end of this 12-year bear market. So what do you do in that case? Do you write it down? The last bear took 53% out of the S&P. The NASDAQ bear in the year 2000 took 79% out of the NASDAQ. No, I don't believe in writing it down. I do believe in a little bit of market timing. You don't want to own a lot of stocks during an earnings recession or in a recession in the U.S. economy. Now, that flies in the face of passive investing and index investing, bogleheads, they call them sometimes, the Vanguard indexers that say, nah, we're just going to ride through it. It'll come back. Well, that's fine and dandy if you're 40 years old or 35 years old or 45 years old. But if you're 75, if you're 70, if you're 65, if you're nearing retirement, if you're retired, maybe you can't come back from a 53% hit to the market. And I do believe when I see those signs, I will say in my macro outlook in the newsletter, look, it doesn't look good. The earnings picture for the S&P 500 is starting to erode, is starting to get worse. That will be a time to harvest the crop of these 12 years of gains in the market and set it aside for a while and let the market do what it's going to do. Let the economy, it's cyclical. The market is cyclical. And I don't believe in writing it down when that time comes. Get this week's newsletter. You can see my current macro outlook, which is getting very important here. You know, this is not a young bull market. This is not the beginning of an expansion. We've had 12 years of expansion. Go to GundersonCapital.com. Get 2 free weeks of my newsletter. We'll be right back talking about the economy and the markets. Welcome back here to the Best Stocks Now show. It's the weekend edition with the professional money manager Bill Gunderson. 21 years behind the microphone, 21 years managing money professionally, former analyst many years ago, writing up research reports on some individual companies around the country. Now watching a 5 to 6% correction that we are now in the midst of. Everybody's been waiting and saying, I'm waiting for a correction to happen. Many predictions. There's always predictions. We're waiting for a correction. There's a correction coming. Well, we're in the midst of one right now. Is it a correction or is it the beginning of a bear market after 12 years of bull? Yes, that's right. 12 years of bull. Earnings have been going up for the last 12 years for the S&P 500. That will come to a screeching halt at some point in time, and earnings will start to recede. But more importantly, what we've got to watch now are earnings expectations. The market looks ahead 1 to 2 years. I would say more in the 2-year range than 1 year. And I think most individual investors are more worried about yesterday, today, tomorrow, next week. Well, once they learn that the market is looking ahead 2 years down the road and start looking at the market through that lens, you'll have a whole different perspective on the market. You'll start looking at earnings forecast as opposed to earnings reports. Earnings reports are looking backwards in the rearview mirror. Looking ahead to earnings forecast, kind of like the crystal ball of where the market thinks the indexes and stocks are headed. Now, there's a lot of people that forecast earnings. Being an analyst at one time, I forecast earnings for individual companies, okay? Now, you take all of those forecasts from all of the analysts out there. There's some 13,500, something like that. You can go to tipranks.com. In fact, you can look up my record and see where I rank versus the bloggers, the writers for Seeking Alpha, which I'm a regular contributor there, and where I rank versus all of these analysts that I'm up against out there across the country. Tipranks.com ranks us all. Just look up Bill Gunderson, Gunderson, and you can see where I rank. You can also read a lot of my articles and market calls. I made a very stunning market call in March of 2020 at the bottom of COVID. I said the market has bottomed here. I was within 4 days of it, and I was kind of cautious at that time. Had some money on the sidelines, obviously, because we were in an unknown vacuum. And I said, you know what? The market sees better days ahead, a year from now, 2 years from now. It's time to go all in. And the market doubled from there. In fact, it was the fastest double in the history of the market. That's why it might be important to see what I'm saying now about the market. That's in my macro outlook of my newsletter every week. I also do technical analysis of all the major asset classes. I could see the Chinese stocks and the emerging markets starting to erode several months ago. Yet I guarantee you there's still a lot of advisors, financial advisors, and so-called money managers that still have their clients in the Chinese stocks and in the emerging markets, when it's a horrible place to be, which begs the question, why do financial advisors not do much when these massive changes and this massive rotation starts to take place in the market? Because they've drank the passive Kool-Aid. that says, no, you put together an asset allocation, spit out of a computer based on age, and forget about what's going on in the world, forget about what interest rates are doing, forget about what China's doing, forget about what the Fed is doing, and you just ride through it, thick or thin. That's the passive way of investing. That's the easy way. If I was a money manager, it would be a lot easier for me to manage passive portfolios. Instead, I am an active money manager. Now, that doesn't mean I'm in day trading every single day, but when I start to see major moves happening in the market and major rotations taking place, I act. I don't pass, right? Well, back in February and March of this year, we had a huge spike in interest rates. No, the Fed didn't hike interest rates. The market took interest rates up, like it's doing now. A little bit, not like February and March, but we have had a little bit of a jump ever since the Fed meeting, the Fed announcement the week before last. And when interest rates rise, what are the most vulnerable areas in the market? The highest PE stocks. They're the most vulnerable. You get a discount rate start to shrink on the future values of those stocks. And obviously the ones with the highest PE multiples or the highest price to sales multiples, they're the most vulnerable. What got hammered back in February and March of this year? Well, most of last year's big winners in the market. Last year was more of a speculative type stock market where you saw a lot of the speculative stocks, the telemedicine stocks, the work from home stocks, the video conferencing stocks, the electric vehicle stocks, the lithium battery stocks. That's what led the market in 2020. This year is entirely different. Yet you've still got mutual funds and the ETFs and the Cathie Woods of the world. They're still buying those stocks, okay? That's their thing. They buy transformational stocks that at some point in the future might be profitable. The Robinhoods of the world, the Coinbases of the world. That's the worst place you can be invested in this current market. Emerging markets are the second worst place you can be invested. Instead, this has been a market this year that has favored, up till now, more reliable, large, dominant, earnings companies that have had very solid earnings for many years and are looking to have solid earnings for years to come. That really narrows down the field, okay? It's been really a small group of stocks that have led the market here so far in 2021, and now they're starting to show some vulnerability here, okay? So we've got to really be on guard. So right now, you could still be sitting in the winners from last year, and you've probably lost all your gains from last year by now, or a big portion of them. You could be in the big stocks that are working this year, at least up until now, or you could be in a lot of emerging markets which are not working this year. In fact, they're a very poor place to be invested. Well, the trend right now continues to be the large, reliable, superior growth stocks. A lot of those come from the technology industry. A lot of those come from the medical sector, the drug sector, etc. Well, things are starting to change once again. We've had a little bump up in interest rates, and we're starting to find where the vulnerable stocks are once again. And we realize that the bull that's been in place for 12 years and the growth in earnings and the expansion in the U.S. economy that's been going on for the last 12 years, other than the COVID year, it's going to end at some point in time. It's not going to go forever. And we have some risk out there. We have some vulnerabilities in the market right now that we have to watch for. We've seen a sudden change in China. They've gone from quasi-capitalism back to hardcore socialism. And it's brought their stock market to its knees. It's disrupted the supply chain across America. and across the world. You saw Bed Bath & Beyond report this week that the supply chain is causing a major disruption. The automobile industry is having a hard time. There's a big semiconductor shortage around the world. We have a valuation problem. We're trading at 21 times forward earnings, which is way above the norm. We've got a persistent inflation problem that's not as transitory as it once was stated to be. And we could have maybe starting to see some slowing growth in the economy. You combine slowing growth with inflation, and you could get stagflation. That's why I believe in being an active money manager and using a little bit of market timing along the way instead of just sitting there and doing nothing. What am I doing now? Well, I write a very detailed newsletter every single week. It is my internal research that I force myself to do every week so I know where the markets are and all the asset classes are at any given time. It goes to my clients and my subscribers, but I offer 2 free weeks at GundersonCapital.com. GundersonCapital.com. We'll be right back.
You gotta go where you wanna go, do what you wanna do, wherever you wanna do, you gotta go where you wanna go.
And welcome back here to the final segment of today's Best Stocks Now show. I do a daily show, Monday through Friday, live from my office in the Mount Pleasant, Charleston area of South Carolina. And that show is heard on many radio stations across America, and it's also uploaded to my website every day at GundersonCapital.com. GundersonCapital.com. About maybe within an hour of the show being done, it's uploaded to those to my website. It's also uploaded to all the major podcast sites like iTunes, TuneIn Radio, iHeartRadio, etc. It's called the Best Stocks Now Show with Bill Gunderson. But there's more to than just Best Stocks Now. You know, you begin with the market outlook, the macro picture, okay? You don't want to, I'm not a guy that believes in being fully invested all the time. There are times when you want to have very little exposure to certain asset classes. You don't want to have a lot of exposure to bond funds in a rising interest rate environment, and you don't want to have much exposure to equities or stocks in a falling earnings environment, which we haven't seen for 12 years now. But it's out there somewhere. When we look at the various asset classes where you can have your money parked, well, bonds obviously are a large part of the markets. I have no problem with owning bonds, but you know, the interest rates are very low right now. To get anything over 4%, you kind of have to go out there into the junk area of the bond market, and I wouldn't advise that right now. I would stay in the 7 to 8 year and very high quality bonds. One of the bonds we own in our Best Bonds Now portfolio is a Netflix bond, for instance, okay? That kind of area, you're going to get a better yield, obviously, than you're going to get with IBM or Apple or something like that. And I believe in this kind of a market, you got to plan on holding those bonds to maturity. You'll get your rate along the way, your coupon, and we've had some appreciation in our bonds. That's been a good deal. I think our bond fund, since we started at 2.5 years ago, is up about 17% from an appreciation point of view because the value of the bonds has gone up either from lowering interest rates or credit upgrades. So bonds are not a bad place to be if you're going to own individual bonds and hold them to maturity. I would not be in bond funds right now because they are at the mercy of interest rates. And it looks like the course of least resistance going forward for interest rates is higher. Stocks have been the king for the last 12 years. That's been the best place to be, while the S&P 500 has gone from 660 to 4,500. But there's another bear out there somewhere. There's another earnings decline. There's another recession in the U.S. economy out there somewhere. And that's why I believe if you're going to be invested in the stock market, which still is the best place to be, I believe in active investment versus passive. Someone watching over your portfolio when trouble starts to arise in the economy or in the earnings picture. You also have the choice of being all in cash, okay? That may be a very good place to be at some point in the future, to have a lot of cash. Sitting in cash during an expanding economy is not a good idea because inflation is eating away. We've seen quite a bit of inflation here recently, and it looks like it's going to be around for quite some time. That eats away at your cash holdings. Precious metals have been a very poor place to be. Normally they do well during an inflationary period like this, but they've done very poorly. Silver's hitting new lows. Gold has gone hardly anywhere. Now, there may be a time in the future, but right now I would just say that has not been a very good performing asset class. Digital currencies, I say this, with the Bitcoins and the Ethereums, et cetera, of the world. You do what you want to do with the digital currencies, but as a professional money manager with a fiduciary responsibility to my clients, I can't put my clients into digital currencies. And the last asset class that a lot of people don't even consider, but it's definitely an asset class, there are inverse ETFs that are inversely correlated. So, for instance, you have the SPY, which is the S&P 500. The inverse of that is SH. And there's times when I hedge my portfolios with these inverse ETFs. For instance, right now I have a hedge against the NASDAQ, PSQ, which is inverse the NASDAQ. There's inverse the S&P. There's inverse the Dow. DOG is inverse the Dow. There's inverse China, FXP. There's inverse the emerging markets, EUM. They go up when those indexes go down, okay? And they can come in very, very handy at times in the market. Well, you can follow along every day with my radio show, my podcast. You can listen at your leisure at GundersonCapital.com. If you're a dyed-in-the-wool do-it-yourselfer, I have a live trading subscription for folks. When I make a buy or sell in one of the portfolios that I manage, you know about it in real time. And you get my newsletter every week that I give 2 free weeks of to new listeners or people that have never gotten it before at GundersonCapital.com. But then there's a lot of folks, they don't have time to manage their own money. They've got other things to do. They've got careers. They've got retirements to live out. They've got grandchildren to visit or children to play with. I manage money. I'm a fee-based money manager. You can check into the portfolios that I manage. They're in my newsletter, GundersonCapital.com. You can call us for a review of your financial situation. You can talk to one of my advisors that work under me at GundersonCapital.com, or the number is, we have an 800 toll-free number nationwide, 855-611-BEST. We have clients from all over America, from all walks of life. We've been on the radio. I've been on the radio for the last 21 years. You can go to my website once again at GundersonCapital.com or get the newsletter or set up an appointment with us, a virtual appointment. You don't have to find a parking place. You don't have to drive downtown, fight traffic, and get in an elevator in a 21-story building. No, you can call us at 855-611-BEST. We run a virtual office. 855-611-BEST. We're in the midst of a correction in the market. Could it get worse? Could it get better? Well, follow along with Gunderson at GundersonCapital.com. Have a great day. Have a great weekend, everybody.
This show is not a solicitation to buy or sell any securities. Bill Gunderson or clients of Gunderson Capital Management may have long or short positions in stocks mentioned during the show. Gunderson Capital Management is a fee-based registered investment advisory firm. All accounts are held at Ameritrade. Ameritrade is a member of SIPC and FINRA.